Hello, everyone, and welcome to the Ventures podcast. I'm excited about today's episode with Gary Raju. He is an experienced investor, capital allocator, asset manager, chief financial officer, and we talk about a number of things on this episode related to the global macroeconomic climate, especially from the lens of entrepreneurship. If you have an existing company and you're trying to figure out how to navigate through the upcoming season, financial climate, and the economy, we dive into a bunch of different things. We also talk about Web3 and his perspective as a finance expert about crypto and how the climate might affect the way that we think about various tokens and DeFi. So that's, I'm glad to be able to talk through that. And then we just get sort of very, very practical about the things that he's excited about, why this is actually a really important season for venture builders and venture investors. So I'm honored that he could carve out this time for us to talk about all the things. So if you're listening to this episode, you can also watch by visiting wclittle.com. There I'll have more extensive show notes and links to the different things that we talk about today. And if you're watching, you can also listen anywhere that you get your podcasts. You can just search for Ventures and it should show up. So with that, please enjoy this episode with Gary Raju. All right, Gary, welcome to the show.
Thank you, Will. Pleasure to be here.
Never a dull moment in venture building, venture investing world. The macroeconomic climate is interesting to say the least. I'm honored to have you on the show. There's so much to talk about. Let's just start by, if you wouldn't mind just introducing yourself, let our listeners, our watchers get to know you a little bit.
Thank you, Will. My name's Gary Raju. My background is in finance and operations in the venture and private equity world for the past 30 years as both an operator of companies, primarily in the chief financial officer role, as well as a capital allocator, working as the head of a ventures arm in healthcare in particular. And so very interesting times, as you say, we live in, indeed.
So, okay, the people listening to this, a lot of venture builders, lots of investors, but for the venture builders, let's actually go way back to like a 101. What is a CFO? How does the role of a CFO evolve as a company grows?
Great question. So companies have assets ultimately, right? They have human assets and they have tangible assets, and the tangible assets and the human assets need to be sustained and maintained for the company to achieve its goals. And the way to do that is through money. And so ultimately, your chief financial officer, their job is to be a steward of that money to ensure that the human assets and the capital assets of the company actually flourish to reach the mission of the company.
So a lot of startups won't have usually a CFO until they get much larger. At what point does the functional role, I mean, so obviously somebody's playing the functional role, but at what point do you actually have a CFO typically in a growing startup?
Yeah, I think that's a great question, Will. And I think the answer, it depends. But ideally, when you have enough money that's been given to you, entrusted to you by either your own money that you put in as a founder or that you raised an initial round of money, where that money was given for a specific purpose to reach a specific goal of the early stage company, that's the ideal time to get somebody, even on a part-time basis, to help you kind of map and track how the money is going to be deployed to reach your goals as a company, and to also be a business partner with you as the founder to help you kind of understand the dynamics between your people and the dollars coming in and the dollars going out to make sure you don't run out of money above all else.
That's right. So okay, so then as the company scales, then what are the types of things, responsibilities, day to day, quarter to quarter that a CFO does?
Absolutely. So a part of the chief financial officer role is actually reporting as a fiduciary role. It's to report on the books and records of the organization and maintain them. So it's important to report financially what's going on for the organization, for its investors, its founders, and all of its stakeholders ultimately to make sure that people know what happened historically in financial terms, and also to help keep a forward-looking eye,
Mm,
looking through the windshield in terms of forecasting and understanding based on what's known at the time, where the company could be headed financially, and also to give the founder an extra brain, right, and an extra left brain to help them kind of think through and analyze, key things, key initiatives, key strategies for the organization, so that it can reach its targets and reach its goals and mission, and in a way that's financially sustainable.
it's good. It's good. Okay, so we're recording this on Monday, June 27th. This will be released on Tuesday, June 28th. Fascinating last week of the quarter here, given all the things going on. What's your overall, a lot of people listening in may not be economists or people that are familiar with the macro environment. Would you mind just give us your, like, what's going on? What are the things that are contributing to what's going on right now? Give us your kind of the talking head points, just to get people up to speed here.
Yeah, so the external market financially will historically, the economy was driven by several factors, right? So one is, is job creation robust? Are companies making money? Are companies generating cash? And when those things happen, the Federal Reserve historically didn't make too many changes. They were able to set their interest rates almost like a thermostat and just leave them that way for a long period of time, and it created a lot of predictability
Mm,
and very little change. It's when times get tough and tumultuous for reasons that the government thinks are not historically normal. For example, the real estate crash in 2008 that triggered the Great Recession, because that wasn't a normal business event in the mind of the government. The Federal Reserve acts, and the way they work is to help ameliorate the suffering and the hard times is through putting more liquidity or money into the market. So lowering interest rates, which encourages businesses to take more risks, right? Like hiring more people and starting that new division or that new product line that they wouldn't otherwise.
mhm,
So when money is inexpensive, meaning a low interest rate, more people will engage in taking those kind of expansion activities and growth activities as businesses go. So we had not just one really abnormal event in the last 10 years. We had two, and so the second one was the pandemic. So these are both somewhat unprecedented in our history as a country, and both were not just events that were localized to the U.S. Ultimately, both of those events were worldwide events.
yeah.
And the so many of the things that the Fed would normally do in terms of raising interest rates after an event like the Great Recession, they really were not able to, in a way, because the pandemic kind of, by the time they got through that cycle, the pandemic just ramped up, and they did almost the exact same thing for the pandemic. They kept interest rates very low, almost to zero, and to ensure that companies had plenty of access to money to allow them to maintain their workforces, and not close down. And so, because of that, so much money's gotten into the system that basically people have borrowed for effectively almost 0% for the last 8 years.
Hmm.
Um, that what's causing it, what's happening now is inflation. All of a sudden, companies have a lot of cash that they borrowed that they're able to pay more money for everything, right? So they can get into a competition for materials and also a competition for people and a competition for office space, and it caused all those prices to go up.
Hmm.
And so the Federal Reserve saw this cycle as being unsustainable, so they started withdrawing liquidity from the market in the form of increasing interest rates. So it caused encouraging people to take less risk and scale back their plans and do those types of activities, cost cutting activities that will allow these prices to start normalizing as fewer and fewer people are just bidding up these assets. And so we're seeing it everywhere, right? From the price of food the inflationary cycle. We're at 7.5% consumer price index, and that's a great proxy for how inflation is measured in
Yeah.
this country. So the consumer price index is just historically a basket of goods that the Federal Reserve would estimate as to how fast they're growing in price. And so currently we're at 7.5, almost 8%. Historically, what they consider a good level to be at is 2%, meaning the price of things grow by about 2% a year. And so currently, with everything that we're all seeing with gas, real estate, food, we're well over 10% on almost all of those. In fact, gas from 2 years ago is almost 60-70% higher than on the average, and from what we saw even just a year ago. And so as this cold water is poured on the economy, the hope is all of these prices will start coming down, and then the Federal Reserve will start reducing interest rates back to a level where it's sustainable. They probably won't go back to 0%, but they will get back to a level where they're sensible and affordable.
Yeah, yeah. No, that's good. That's a good overview. So how should entrepreneurs? Let's take them in different phases. Let's actually start in reverse order. Let's start with established entrepreneurs that have growing businesses. Maybe let's take maybe all kinds of entrepreneurs, but let's maybe, given that the show is called Ventures, maybe people that have raised venture money. How should they be thinking about this current climate and the upcoming season that we're looking at here?
Yeah, it's a great question. So the real question and the challenge for entrepreneurs with established businesses right now are going to be, how long is this recession going to last? So the two recent historical precedences that we've had was the dot-com bust, which led to the recession in the early 2000s. So that lasted about 3 years. The Great Recession lasted about 3 years as well, ish. The pandemic, the recession triggered by that lasted about 18 months. So historically, the range of how long this could go is between 18 months to 3 years in terms of recessions. And so based on that, understanding how your business is doing, number one, is it cash flow positive or not? If it's cash flow positive, you have a lot of good opportunities. Right now, your ability to continue to expand a bit, to hire people, which are going to be more affordable, and also do certain expansion plans, will be more readily available to you as an opportunity. If you're not cash flow positive, so that this is where it gets a little bit challenging.
Right.
Your ability to raise capital right before you run out of money in the next 18 months to 3 years is going to be very challenging. So to the extent that you'll be able to raise money, you're going to have to be a company that has a really good product at a very high gross margin, low customer acquisition costs. And the way I describe a high margin is 70% gross margin or better on your products. So a lot of software companies fall into that category. Your customer acquisition costs are paid back within a year, meaning that if your product costs $99 a month and you make $50 a month on that product in gross margin, and your customer acquisition cost is only $100, then you're basically paying back that customer acquisition cost in 2 months. So if your product is good enough and popular enough where your customer acquisition costs are being paid back in less than 6 months, or maybe even a year, right? Definitely less than a year.
Yeah.
You're going to be in good shape. Both of those, those type of companies, they'll still be able to raise capital,
Right.
meaning that there's enough upside for most investors that people are still willing, even in the dark times, they're willing to put money in at that point.
Right.
Plus, if your product and your services are not at those levels, it's time to really work as a team, you and your team, to understand how you can improve your gross margin within your products. Is it maybe looking at the underlying costs? Is there one or two extra bells or whistles that you're adding to the product that makes it more expensive, but it's not actually causing you to be able to price your product in a way where you can get to a good gross margin? Taking a look at your sales and marketing spend, is it really returning what you thought it's giving you in new customers, and really focusing on those things to improve those numbers to the best of your ability. And then finally, if you're still not cash flow positive at the end of those two tactics, it's really important to start taking a look at your overall costs and look at, unfortunately, things like people and other things that you can perhaps put a hiring freeze on, or in some more drastic cases, even doing some headcount reduction to just right the ship so that you don't have to raise money unnecessarily
Right.
in the next year and a half at least.
Right. Right. It's good. That's good. All right. Well, what about the new entrepreneur? Somebody who's thinking, maybe now's the time, right? Because the last, for what was it, 13 years ago, that was the golden age of the new tech companies that now, a decade plus later, are all the companies that everybody talks about. So are we heading into another one of those seasons where the new entrepreneurs have an amazing opportunity to build, or what's your overall read or advice for new entrepreneurs?
Yeah, no, this is going to be an exciting time for new entrepreneurs. So historically, some of the most iconic companies came out of recessions. So Amazon started during a recession, PayPal started during a recession. So there's plenty of evidence that can be done, and a part of what spurs that is during a recession, you have a lot of people who are in comfortable jobs who got laid off or had to move on, or different events that cause change, right? And it's those folks at this stage in their lives that may consider, hey, I want to do something different. I don't want to work for Microsoft anymore. I want to actually start something on my own. And in essence, that when you look at the PayPals and the Amazons and the Airbnbs that started during recessions, many of the founders, if not the founder themselves, many of the people who work with that founder, they were able to get from people who left their existing employment opportunities, and we were able to build great teams that can really launch things and do it at velocity. One of the things, Will, that's been really challenging for founders in early stage companies the last year and a half, just given the inflationary environment for labor, it was really hard to staff some of the platforms that they were trying to build. Getting good coders, getting good sales and marketing people,
Right.
even getting good accountants and HR and people like that to make your company go. We think that's gonna be an opportunity in the next 18 months, as those resources come back online. If you're cash flow positive, the world is almost your oyster in terms of your ability to get really great people at prices that you wouldn't be able to get a year ago. Your ability to negotiate with vendors you wouldn't be able to, and so the main thing is to really work on creating that cash flow and not get overwhelmed by the situation of the external market. It's really not under any of our control individually, right? It's time to really focus and lock in on the mission of your organization and bring the team together and think through what the next 18 months to 2 years are going to look like. And then above all else, the one metric everybody should learn how to calculate as a founder, even if you don't have a CFO, is understand what your burn rate is. I mean, how much money are you spending a month if you're not cash flow positive, and how much money is in the bank. So how many months of runway do you have before you need more money, and look for ways to extend that runway if you can for 18 months. And so it buys you as much time as possible until we can get out of this situation, and there'll be brighter days ahead, and I think capital will be more deployable. If you're in the unfortunate situation where you don't have a choice in the next year or so, where you're going to have to raise money, I think that the tragedy is it's going to be really challenging to raise money in the first place. And if you can, the valuations that you got a year ago are going to be substantially lower in this environment than in good times. So a year ago, if your company was their valuation, let's say you're a software company, and your valuation was 100x your ARR. In about a year from now, it could be as low as 30x your ARR. So your second round may be the same valuation as your first round. So just be prepared for that and understand that that's a reality. But also try and avoid that if possible. Let's just try. The key is to get through this donut hole and get to the other side when it's going to be more favorable to raise money at a valuation you could be proud of and your current investors could be happy with.
Yeah. All right, so I have to ask, given the theme of the last few dozen episodes of this show, but crypto, Web3, as a CFO, as a finance person, what's your overall, like, what when you just even hear the word crypto, right, or start talking about Web3, or like, how, what's your overall take on it? Is this hype? Is it nothing? Is there something here? What's your commentary on the space?
Yeah, it's a really great question. Well, so I think so. I lived through the dot-com era, so I'm
Mm,
old enough to remember that, right?
mhm,
Um, basically people gave up on dot-coms and the internet because of that recession. A whole group of investors did.
mm,
But the truth is, there was nothing wrong with Web 1, right? That was actually revolutionary at the time. Still is.
mm,
There's just so much money deployed in things like Pets.com and Webvan that had nothing to do with the value of the underlying technology. It's just there was too many side case corner cases that investment theses were built on around products and services that people should, if they really thought about it, right? What was the total addressable market for this in the first place, even if
right.
it worked? And I feel like we're in a similar situation with Web 3, right?
Mm,
I think it's going to be transformational for humanity. Web 3 is so that's what everybody believed 6 months ago. There's no evidence that anyone should change their mind now.
mhm.
The real key is to understand the corner cases that business models are being built around, and are those really viable? But I think the core technology, I think, is there. I think smart investors, right, and especially smart CFOs know not to panic now, because we see the potential of
Mm,
what this technology could mean to be transformational to humanity. And now's not the time just to fold up shop because you're seeing the price of Bitcoin go up or down, because it's so much more than just a cryptocurrency. Ultimately, the
yeah.
blockchain and Web 3 is about helping transform society, helping us create a hedge against lots of things, right? Like inflation in the future, and personal identity and self sovereignty, and so those are the reasons I feel very optimistic about Web 3 and cryptocurrency. That being said, though, many people are panicking right now when they hear cryptocurrency, just based on what they're seeing with the price of Bitcoin and Ethereum and things like that. And to the extent that your business model does not necessitate creating a cryptocurrency right now, it's probably for the better, right? But everything else that you're doing um, should not be impacted. If you're creating great blockchain technology for estate planning, for example, or for credentialing of medical providers, to me, none of those use cases are going to be impacted in the long run by what's going on in the
Right.
crypto world right now.
Right. Right. Okay. So then, as a smart CFO, DeFi, decentralized finance. It's been a really interesting last couple of years since DeFi really started taking off, and the promise of banking the unbanked, the promise of being able to generate APYs that are way above traditional banking systems, the promise of being able to truly decentralize this so that censorship and other forms of blocking or taking advantage of being in the middle can go away. What's your take on DeFi? Like, do you think this is good for the world? Do you think we're heading that direction, or do you think that this is more of a pipe dream?
No, I believe it's extremely good for the world. Especially when you think about the non-Western world. If you think about places like Asia and Africa and South America, most of the transactions are so small, right? Meaning the currency is
Mm,
much lower valued than the U.S. dollar.
mm,
If you're trying to make a transaction for food in India, for example, or in Africa, the traditional banking system has failed, right? So Visa, Mastercard, and all the it's not frictionless. It's very high cost for most people in the world to really engage with it in a meaningful way.
mm, mm.
And so DeFi systems are absolutely needed, and I think they've got an incredibly bright future. And and the founders that right now are pursuing that, right? I think the space is vibrant and is starting to segment into rational spaces within DeFi that I think is really exciting. And also, large countries are engaging in DeFi in their own way. And I mean, centralized DeFi in a way. So, for example, they in India they created the RuPay system, which basically bypasses Visa and Mastercard to help make transactions for small vendors who historically couldn't afford to take credit card payments to be able to all of a sudden transact electronically, right? So I think that's the future for DeFi is great, and I think it's a vibrant subsection of the whole crypto space that I think is super exciting, and as I think most investors are going to continue to invest in that space without really that much interruption.
Yeah, no, I agree. So okay, so as a investor, asset manager, CFO type, what other either other parts of Web3 or just in general, what are the spaces that you're most excited about moving forward? Like, where are you going to be looking to deploy capital and manage assets and encourage entrepreneurs to build in?
Yeah, to me, there's at least three distinct spaces that I'm super excited about. Healthcare is part of my background, so
Mm-hmm.
so I think there's so much exciting stuff in healthcare, especially in telemedicine, blockchain with healthcare in terms of patient safety and patient credentialing. So there's the improving access through telemedicine, making it so people who live in remote geographies can get care easily and seamlessly. Also, taking the friction out of the healthcare system in terms of validations, making sure that using blockchain to help identify that the patient you're treating is the patient you should be treating as a doctor, right?
Right.
And improving patient safety. So those are areas I think are super exciting, and I think they're going to be easy to deploy, right? So one thing is creating a great, robust solution, but also a solution that's easy to deploy, that's easier to work with than the current solution that's out there. So I think healthcare in those two areas are really great, and I think Prota in particular. We have several holding partners that are going to look specifically in those areas in terms of future areas of investment, which is really exciting. To me, I also think that believe it or not, just manufacturing and general products, consumable goods are going to be exciting going forward, particularly around sustainability. As we see supply chains get consolidated over time, there's a trend of deglobalization, right? There's a decoupling from China and the U.S. More things are going to be insourced and locally sourced. And so, how consumable goods are going to be delivered in the future are with different types of supply chains, and also with mandates for them to be environmentally friendly and sustainable.
Right.
I think there's going to be some really exciting technologies that emerge from that.
Mm.
And then the third one I am very, very interested in is technology, investment around ag tech in the future. So I think as the world becomes, as we're starting to see with the impacts of global warming and global supply chain shrinking, there's going to be more and more interest in having technology that creates abundant yield in agriculture that's sustainable and also organic, right? With little or minimal chemical pesticides or genetic modification. And so that's also an area that there's a lot of great early stage investing opportunities to be had.
Love it, love it. Okay, that's really insightful. Thanks for sharing that. Okay, any final words? So we hit a number of really important themes in this conversation, but anything that you want to say in summary?
Yeah, no. So first of all, to the founders out there, again, now's not the time to get to look at the macro environment and get overly depressed over it. It could be an exciting time of opportunity for those who are organized, who really understand their business, who get into the numbers of the products and services that they're making, and then number two, you can do it. So you've worked hard to create a business. You took major risk and chance in your life to do this. You'll be able to get through this period of recession as long as you stay focused, disciplined, and motivated. And then finally, Prota is here to help you. In any way we can. We have a robust studios arm, a labs arm, and obviously a ventures arm for additional investment. So want to encourage all of you to engage with the Prota ecosystem as founders and allow us to help you.
Love it. Love it. Okay. So then on that end, how can people find you, learn more about Prota? Where can people continue the conversation with you?
Yeah, you bet. So feel free to reach out to me at gary.ragu at protaventures.com. And we have an entire team that can help you understand and learn about all the things that we do and how we help founders. We're an organization that was created by founders, and so we feel like we're in a unique position to help early stage founders flourish and create great things that are transformational for society.
Love it. Love it. Gary, this has been great. Really appreciate your time.
Thanks, Will. Have a good one.
All right, a couple quick things before you go. Number one, I have a general newsletter where I write about technology and startups and health science and teaching people to code. And I write about a variety of different subjects that we talk about on this show. So if you go to wclittle.com, there you'll be able to subscribe, and you'll also be able to subscribe to particular topics. If you're just interested in one or a few of them, you'll be notified right when I publish new content in those areas. Number two, my partners and I at Prota Ventures have a portfolio company called Startup Rocket. If you go to startuprocket.com, there you'll be able to receive coaching guides and customize an operations framework for you and your team and your advisors to be on the same page in terms of what is the appropriate next step for you and your entrepreneurial journey. And finally, if you wouldn't mind leaving a review anywhere that you have listened to this podcast or watched this podcast, it would be super helpful to help those who might be interested in consuming this content as well. Thank you.